visibility on. So, like I put my, my Bitcoin, my USDC, and my Mamo on there. It's moving it around on Moonwell to different vaults, and to maximize my earning. But I don't know what it's buying and selling. So, how does the IRS look at that? It's
This is why the final regulation is going to matter so much. So in the securities world, so two things. One, this is why I would recommend anybody that can afford to do it or has the assets or whatever, convert to a Roth IRA or create a Roth IRA and get a self-directed IRA on one of these platforms that supports crypto, and you can do all this in there and not worry about it. In a traditional IRA, you don't have to worry about it either. It's just you're not going to touch your money till you're 59 and a half years old. But in a mutual fund, so let's say you buy XYZ, you buy 100 shares of, Taylor's mutual fund. So, well, what really happens at the end of the year is Taylor could be day trading in that fund, and at the end of the year, all of those things are passed through to you as an aggregate loss or not, right? It's all kept track of. So you are liable for that, even though you're not the one pulling the trigger, because when you bought the mutual fund, you're effectively giving almost like a power of attorney to the money manager. So if I was the IRS, I would simply, or if I was the United States government and I want revenue, which of course they do, I would be like, look, yeah, everything that cycles back to you that you then convert to some other position or is a growth in the form of a deposit of more coin than you had, you're gonna pay taxes on it. It's gonna be ordinary income. I don't really see why it wouldn't be. Now I do understand what Taylor's saying is I do understand that, but the flip side of that argument is when you buy a bond, you're lending money to, like if you go buy a bond directly from a company, you're lending money to that company and they're paying you interest, and at the end they're going to pay you back your principal.
Yeah, but that's how what happened. DeFi, that's not what's happening. You're not getting paid interest. You're getting paid gas fees for what they're doing. So the fees, they're using your crypto, and when they do that, they buy and sell your crypto, and they lend it out in that transaction in order for the transaction to happen quickly.
You're basically providing liquidity for swaps. So like if somebody wants to swap Ethereum for Bitcoin, Bitcoin for Ethereum, then you would put an equal amount of Bitcoin and Ethereum in a liquidity pool to facilitate the swapping between those assets.
Right. And I'm just saying now.
And whenever anybody does that, they pay a very small fee, and part of that small fee gets paid to you for providing that liquidity.
Yeah. Sure. The hard part here is that you can't do that with stocks or T-bills or bonds.
You actually can now, because with the tokenization of those, like Nest Credit, or Nest on Plume Network, they have tokenized treasury bills. And I was actually telling Taylor about this a couple days ago, where you can buy tokenized U.S. treasury bills, earn 4%, and then you can take out a loan against it for like 0.08%. In a PUSD, a stable coin backed by USDC. And so, there is ways that you can use, treasury bills and, and other traditional vehicles in DeFi now.
Yeah, but the reason why it's not comparable is because you don't have gas fees exchanging or swapping stocks or bonds. That doesn't exist in that world.
Not yet.
Yeah, not until it gets tokenized.
I want to be clear. I'm not saying that the gas fee structure, like you're talking about, is what's causing the taxation. I'm simply saying that, let's just say for fun, and I understand it's a little bit more difficult because you got the balance of the two different assets. But let's say you get to the end of the year, and you start the year with 1,000 tokens, and you end the year with 3,000, and the entire thing, all you did was the yield, right? DeFi. I'm saying that the IRS is going to look at those 2,000 tokens. As those tokens hit your account, what were they? What was the net value in US dollars worth at the time? You add it all up. That's your income.
And that's why I want to cash out in USDC, because if I'm cashing out in USDC, that during that taxable event, I'm locking in that value. So
exactly.
If I was cashing out in Bitcoin, and Bitcoin has a pullback when it comes time to pay the IRS, then basically, I might be paying, $50,000 worth of taxes when I actually only profited 25 grand.
Right. So yes, and that's what I was trying to get across is you've
Yeah.
got to be the volatility of the asset class dictates that you at least be aware of A, what is my tax liability, and B, where am I planning on paying it from? Because I would suspect that a lot of people are going to be like, well, I've got yield, but I'm also investing for the long haul for appreciation on these coins that I think are going to go up, or these assets are going to go up. And then you get the double hit of, well, now I got to sell the crypto to have capital gains that I'm going to have to pay the next year to pay my income from this last year. And so you just want to be careful. It doesn't mean it's a bad investment by any means. It's just you don't want to be ignorant of what you're incurring as you.
Yeah, but Jeff, I'll explain. I need to go into a little bit more detail so you understand DeFi a little bit better, because I'll show you why if it is done that way, it will destroy the DeFi market.
Let's actually do, if you guys don't mind, we have about 20 minutes left, and I want to talk about the outlook for August, but let's actually do let's kind of game plan an episode and really dive into strategies on how to potentially cash out this bull run and mitigate our people's tax burdens.
All right.
Does that sound like a good idea?
You guys want to stay on the tax thing, or do you want to talk about like the market? Like what
final thoughts on taxes, Taylor?
And the taxes part, the taxes part are going to be incredibly complicated because there is nothing like DeFi in traditional finance, and so there isn't really any rules right now. The easiest way I could tell people to think about it, why this idea, what Jeff's talking about, is logically, I think, where you would come to what the way that you would treat it, trying to be the same as stocks. I'll have to go into a little bit more detail why, if it is that way, we're all